Every morning, Warren Buffett drives the same route to work. Not a motorcade, not a helicopter, a car. He drives himself. The route takes about 5 minutes. He stops at McDonald's on the way. He orders from a short list of options. The price determined, he has explained, by how good the previous day's market was. A strong market. The 3.17 bacon, egg, and cheese biscuit. A weaker one. The 2.95 sausage patty. A bad day. 2 sausage patties for $2.61. He has a net worth of approximately $150 billion. He eats a $2.61 breakfast. He lives in the same house he bought in 1958 for $31,500. He has not moved. He does not have a yacht. He does not own a private island. His phone, until relatively recently, was a flip phone. His secretary, who has worked for him for decades, answers calls that could redirect half the global economy. Now, here is what makes this interesting. Warren Buffett is not doing any of this for show. He is not performing modesty the way some billionaires perform excess. He is not managing a brand image. He genuinely, authentically, enthusiastically does not care about the trappings of wealth. And this turns out to be, not despite being strange, but precisely because it is strange, the most important fact about the greatest investor who ever lived. Because wealth, to Warren Buffett, was never the point. It was never the measure. It was never the goal. The game was the point. The game of finding value where others saw nothing. The game of understanding a business so completely that you knew, while everyone around you was panicking or celebrating, exactly what it was actually worth. Rockefeller built pipelines. Branson built experiences. Trump built mythology. Warren Buffett built something no one had ever quite built before. He built a money machine that runs on reading, patience, and the radical willingness to do nothing while everyone else does something. And it made him richer than all of them combined. Warren Edward Buffett was born into a world that was coming apart. The Great Depression had been grinding for nearly a year. Banks were failing. Breadlines were forming. Across America, men who had been confident and prosperous 18 months earlier were selling apples on street corners. The economy, the whole magnificent edifice of American capitalism, had revealed itself to be a structure built partly on illusion, and the illusion had cracked. Most children born in this environment absorbed fear, a visceral generational terror of loss, of having it and then not having it, of the ground giving way. Warren absorbed something different. He absorbed curiosity. His father, Howard Buffett, was a stockbroker, not a wealthy one. The Depression had seen to that, but a principled one, a man who believed that markets, when you understood them, told a kind of truth. Howard took his son to the office on weekends. Young Warren sat on the floor and watched the ticker tape roll, not understanding it yet, just watching the numbers, feeling the rhythm of it. By age 6, Warren Buffett was selling chewing gum door to door. Not randomly, strategically. He had observed that juicy fruit sold better than other varieties and stocked accordingly. He tracked his margins. At age 6. At 7, he checked out a book from the Omaha Public Library called 1,000 Ways to Make $1,000. He read it in an afternoon. He read it again. The concept that lit up his brain. The concept that he later described as a kind of electrical revelation was the idea of compound interest. Here is compound interest in the simplest possible terms. If you have money and it earns a return, and you don't spend the return but instead reinvest it, and that reinvested return also earns a return, and you never stop, the growth is not arithmetic. It is exponential. It is a snowball rolling downhill, getting bigger with every revolution, not because you push it harder, but simply because you don't stop it. Most 7-year-olds hear this and nod politely. Warren Buffett heard it and felt the future. When Warren was 11, his father won a congressional seat and the family moved to Washington, D.C. Warren hated it. He missed Omaha. He was miserable enough to write letters threatening to run away. He actually did run away. Briefly. He was 11. But Washington gave him something Omaha couldn't: scale. And scale, to a mind already wired for capital allocation, was irresistible. He started delivering the Washington Post. Not just carrying papers, managing routes. Multiple routes. He mapped them for efficiency. He negotiated with the Post. By the time he was 13, he was delivering 500 papers a day across 2 routes, earning more money than most of his teachers. He filed his first tax return at 13. He listed his bicycle as a business expense. He deducted it against his paper route income. The IRS, it did not argue. He and a friend bought 3 pinball machines for $25 and placed them in barbershops across the city. Within months, they owned 7 machines. They were clearing several $100s a month. In 1945, they eventually sold the business for $1,200. Notice the pattern. It's not the money that's interesting here. It's the system. Every venture Warren entered was designed as a self-replicating system. Paper routes managed for efficiency, pinball machines placed in high-traffic locations, capital from one venture deployed into the next. He wasn't spending his earnings. He was building a structure. In 1947, he graduated high school with $5,000 saved, roughly $70,000 in today's money. He was 16. He did not particularly want to go to college. He felt he already knew more about business than most professors could teach him. He was not entirely wrong, but he went anyway. And at the Wharton School of Business at the University of Pennsylvania, he encountered ideas that confirmed and sharpened something he'd already sensed. And then he transferred to the University of Nebraska, finished his degree in 3 years, and applied to Harvard Business School. Harvard rejected him. It was the greatest mistake Harvard ever made, because rejection sent Warren Buffett to Columbia University. And at Columbia, he walked into a classroom and found the man who would give him everything. Benjamin Graham was the philosopher king of investing, a Columbia professor who had lived through the 1929 crash, lost nearly everything, rebuilt, and emerged with a framework, a rigorous, unemotional, mathematical framework for understanding what a share of stock actually was. Before Graham, most of Wall Street was essentially gambling in suits. Stocks went up because people believed they would go up. They went down because people believed they would go down. Momentum, rumor, and sentiment were the engines. Analysis was decoration. Graham said, "No. A share of stock is not a ticket in a lottery. It is a fractional ownership stake in a real business. And real businesses have real calculable values. Value that can be determined by examining earnings, assets, competitive position, and cash generation. And if you can identify businesses that are trading at a price significantly below their calculable value, what Graham called a margin of safety, you are not speculating. You are buying dollars for 50 cents. The market, Graham argued, was not a weighing machine that accurately measured value in real time. It was a voting machine, swinging between euphoria and despair. And the job of the intelligent investor was not to follow the votes. It was to quietly, patiently exploit the gap between what the voting machine said and what the weighing machine would eventually confirm. Warren Buffett sat in Graham's class and felt every neuron in his brain align. He later said it was like St. Paul on the road to Damascus. Everything he had already intuitively understood, buy cheap, be patient, let the numbers do the work, was here given a complete philosophical and mathematical framework. He got the only A+ Graham ever awarded. He asked to work for Graham for free. Graham said no. He went back to Omaha. He waited. In 1954, Graham called and offered him a job. Buffett moved to New York so fast, he practically left a cartoon dust cloud in Nebraska. In 1956, Benjamin Graham closed his partnership and retired. He offered Buffett a share in the business. Buffett declined, politely, warmly, and with the calm certainty of a man who already knew his next move. He went back to Omaha. He was 25 years old. He had $174,000 in savings, and he started a partnership. The Buffett partnership began with 7 investors, family, friends, and relatives, who contributed a total of $105,000. Warren's contribution was $100 of his own money. The structure was elegant. He would take 25% of profits above a 6% annual return. If the partnership underperformed, he took nothing. His interests were perfectly aligned with his investors. He worked out of his house, then out of a second bedroom. No secretary, no research team, no Bloomberg terminal. This was 1956. Just Warren, a telephone, an enormous appetite for reading financial documents, and a mind that was becoming, through daily practice, the sharpest analytical instrument in American finance. The results were almost offensive. In the 13 years of the partnership, 1956 to 1969, Buffett achieved a cumulative return of 2,894%. The Dow Jones achieved 153% over the same period, in every single year, without exception. Not a single down year. Not a single year when the partnership underperformed its benchmark, at a time when the prevailing academic theory was beginning to argue that consistently beating the market was impossible, that markets were efficient, that all available information was already priced in. Warren Buffett was beating it by roughly 22 percentage points per year. Every single year. The academics had a response to this. He got lucky. Buffett had a response to that. Let's wait and see. To understand the Buffett method in the partnership years, you need to understand a concept he borrowed directly from Graham and later, crucially, discarded. Graham called it cigar butt investing. The image is vivid and slightly disgusting, which is exactly why it works. Imagine finding a cigar butt on the street. It's used. It's not pretty. Nobody wants it. But there might be one good puff left in it. If you can get that puff for free, or close to free, it's a profitable transaction. You don't love the cigar. You don't want to keep it. You just want the last puff. In investment terms, find businesses that are so beaten up, so unfashionable, so thoroughly hated by the market that their stock price has fallen below the value of their underlying assets. Buy them cheap. Take the value. Move on. Buffett did this brilliantly in the 1950s and 1960s. He would dig through Moody's manuals, enormous reference books listing financial data on thousands of companies, looking for the ugliest, least loved businesses on the planet. Companies in decline, companies in dying industries, companies that nobody at a cocktail party would ever bring up, companies that were, in accounting terms, worth more dead than alive. He found one such company, a New England textile manufacturer called Berkshire Hathaway, and began buying shares in 1962. The company was terrible. Its industry was being destroyed by cheaper foreign competition. Its best days were so far behind it, they needed a telescope. But its liquidation value, its machinery, its inventory, its factories, was higher than its stock price. And here is where the story takes a turn. Because a man named Seabury Stanton, who ran Berkshire Hathaway, made the mistake of going back on a verbal agreement about the buyback price of Buffett's shares. It was a small betrayal, a matter of a few cents per share. But it enraged Warren Buffett so completely, not out of greed, but out of the genuine offense of being lied to, that instead of selling his shares, he bought more. Then more. Then enough to fire Seabury Stanton. He later called this the dumbest thing he ever did. Because now he owned a textile company that was structurally dying, consumed management attention, and generated very little cash. He described it as getting angry and trying to stub out a cigar butt, and finding himself with a full-sized ash. But in a twist that defines his entire career, the mistake became the vehicle for everything that followed. In 1959, at a dinner party, Warren Buffett met a lawyer from Los Angeles named Charlie Munger. They talked all night. They talked about business and psychology and history and philosophy. They had the same sense of humor. Dry, precise, slightly savage. They had the same obsessive interest in how things actually worked beneath the surface of appearances. They became, in Buffett's words, two minds and one wallet. Charlie Munger was not Benjamin Graham's student. He had arrived at investing through a different door. Through law, through psychology, through an extraordinary breadth of reading. In fields that most investors considered irrelevant. He thought about competitive moats, about the psychology of human misjudgment, about why businesses with certain characteristics compounded value over time, while businesses with other characteristics destroyed it. He brought Buffett a question that Graham had never quite asked. What if, instead of buying mediocre businesses cheaply, you bought great businesses at a fair price? The logic was subtle, but transformative. A mediocre business bought cheaply offers a one-time profit. You buy, you extract the value, you move on. A truly great business, bought at a fair price and held essentially forever, compounds value year after year after year. It doesn't just pay you once, it pays you continuously. And the compounding of a great business, held for decades, produces returns that make the cigar butt method look like scraping pennies off the pavement. Munger told Buffett, "Forget what you know about buying fair businesses at wonderful prices. Instead, buy wonderful businesses at fair prices." This was, in the history of investment philosophy, a Copernican shift. And Buffett was smart enough to recognize it. He closed the Buffett partnership in 1969, partly because he felt the market had become too frothy and overvalued, partly because he wanted a different structure. He consolidated his investments into the vehicle he'd accidentally acquired out of spite, Berkshire Hathaway. He would spend the next 50 years turning a dying textile mill into the most remarkable investment vehicle in financial history. In 1967, Buffett made his first insurance acquisition, National Indemnity Company of Omaha, purchased for $8.6 million. It seemed on the surface like a modest deal, a small regional insurance company. Unremarkable. It was, in fact, the structural foundation of everything. Here is why. Insurance companies collect premiums from policyholders up front, today, and pay out claims later, sometimes much later, sometimes never. If no claim is made, the money sitting in between, collected but not yet paid out, is called the float, and in most insurance companies, the float is managed conservatively. Treasury bonds, safe instruments, a modest return. Warren Buffett looked at the float and saw something else entirely. He saw a source of free investment capital. If your insurance business is profitable, if you collect more in premiums than you pay in claims, which the best-run insurers do, then you are not just earning returns on the float. You are being paid to hold the float. Your cost of capital is not just zero. It is negative. Someone is paying you to use their money. This concept, the profitable float as a source of essentially free investment capital, is the secret engine of the entire Berkshire Hathaway machine. Buffett used float from National Indemnity to buy more stocks and businesses. He used the profits from those businesses to fund the acquisition of more insurers, GEICO, General Re, or dozens of others. More insurers meant more float. More float meant more investment capital. More investment capital meant more returns. More returns funded more acquisitions. It was a flywheel, and Buffett had found a way to make it spin faster with every revolution. By 2025, Berkshire Hathaway's insurance float exceeded $170 billion. $170 billion of essentially free investment capital. Money. Buffett has been paid over decades to hold and invest on behalf of policyholders who may never make a claim. The float is not in most textbooks. It is not taught in most finance courses. It is the most elegant financial structure built by any investor in the 20th century. And it is the reason why comparing Buffett to other investors is like comparing a chess grandmaster to someone who plays drafts. The games look similar. They are not the same game. Armed with the float engine, Buffett went shopping. Not frantically, not competitively. With the patience of a man who understood that the right business at the right price would always eventually present itself, and that the worst thing you could do was buy the wrong business at the wrong price just because you were bored. The See's Candies acquisition in 1972 deserves its own moment. Buffett paid $25 million for a California confectionery company. It seemed, to the cigar butt-trained part of his brain, almost expensive. Charlie Munger pushed him to buy it anyway. See's had something that almost no amount of financial analysis could fully capture: pricing power. It was a brand so embedded in Californian gift-giving culture, Valentine's Day, Mother's Day, Christmas, that customers would pay whatever See's charged without thinking twice. They weren't buying chocolate. They were buying an emotional transaction, a ritual, a feeling. You cannot put a price-to-earnings multiple on nostalgia, but you can absolutely profit from it. Between 1972 and 2011, See's Candies generated over $1.65 billion in pre-tax earnings on the original $25 million investment, while requiring almost no additional capital investment. The business didn't need new factories or new equipment to generate more profit. It needed more boxes at Christmas and more heart-shaped tins at Valentine's Day. This was the Munger lesson, perfectly demonstrated. A wonderful business, bought once, held forever, compounds in ways that no cigar butt ever could. Then came the investment that, more than any other, defines the modern Buffett. In 1988, Buffett began quietly buying shares in Coca-Cola. He eventually acquired a stake representing roughly 6.2% of the company, paying approximately $1.3 billion. Coca-Cola in 1988 was not a hidden gem. It was the most recognized brand in the world. It had no moat that a financial analyst hadn't already priced in. The conventional wisdom, the efficient market hypothesis that Buffett had been quietly disproving for 30 years, said there was no edge available in a company this well known. Buffett disagreed. He looked at Coca-Cola and saw something the quarterly earnings crowd couldn't. He saw a brand that would be consumed in increasing quantities by an increasing number of humans for the foreseeable future. He saw pricing power that had never meaningfully eroded in a century. He saw a business that required very little capital to grow, because the syrup formula and the brand were the assets, not factories or equipment. He saw, in short, a business that would still be excellent in 50 years, and his time horizon was 50 years. Today, Berkshire's Coca-Cola stake, now worth approximately $25 billion, generates over $700 million in annual dividends from a $1.3 billion investment every single year, without Warren Buffett doing a single thing. That is the compounding machine in action. That is patience as a financial strategy. To understand what makes Warren Buffett genuinely extraordinary, you have to understand his relationship with financial catastrophe. Normal investors, even sophisticated ones, experience a market crash as a kind of physiological event. The amygdala fires, cortisol spikes. The body, which evolved to treat loss as an existential threat, produces a powerful, insistent signal. Sell. Get out. Stop the bleeding. Preserve what remains. This is the most expensive neurological response in financial history, because market crashes are not the end of the world. They are sales. During the savings and loan crisis of the late 1980s, when financial institutions were collapsing and the markets were falling, Buffett was buying. during the long-term capital management collapse of 1998, when a hedge fund run by Nobel Prize winners nearly brought down the global financial system. Buffett offered to buy the entire fund. His bid was rejected. He went and found other bargains. In 2008, as Lehman Brothers fell and the global financial system entered its worst crisis since 1929, Warren Buffett wrote an op-ed in the New York Times. The headline was, "Buy American, I Am." He deployed $15.6 billion in the 3 months following the Lehman collapse, buying Goldman Sachs, General Electric, and other companies at crisis-distressed prices with preferred terms that only someone with his capital and his reputation could extract. His Goldman Sachs deal was almost comically favorable. He invested $5 billion in preferred shares, paying a 10% annual dividend, $500 million per year guaranteed, plus warrants to buy ordinary Goldman shares at $115. Goldman stock subsequently tripled. The total profit on that single transaction exceeded $3 billion. He was later asked how he maintained such calm while the world was panicking. His answer was characteristically simple. Be fearful when others are greedy, and greedy when others are fearful. 7 words. The most profitable 7 words in the history of investment advice. What looks like emotional serenity is actually intellectual preparation. Buffett doesn't remain calm in crashes because he has better nerves than other investors. He remains calm because he has done the work in advance of understanding exactly what his businesses are worth. So when the market tells him they are worth half that, he doesn't see a crisis. He sees an opportunity to buy more of what he already understood was valuable. The preparation is the calmness. The calmness is the edge. Every year, Warren Buffett sits down and writes a letter to Berkshire Hathaway shareholders. It goes out in February. It is roughly 15,000 words. It is free to read on the internet. It is also, arguably, the most valuable educational document in the history of finance. Other CEOs write letters that are exercises in corporate self-congratulation. Pages of carefully lawyered prose explaining why everything that went well was strategy and everything that went badly was unforeseeable. Buffett writes about his mistakes, in detail, with a specificity that makes institutional investors wince. He wrote at length about Berkshire Hathaway textile operations, describing in painful detail how long he stayed in a dying industry when he should have exited, how much capital he destroyed by trying to turn around a business that was structurally doomed, and what he learned from it. He wrote about acquisition mistakes, companies he overpaid for, managements he misjudged, businesses whose competitive advantages he failed to properly assess. He wrote about U.S. Air, in which he held preferred stock in the early 1990s, and described the experience with characteristic self-deprecation, noting that investors in the airline industry over its entire history had collectively lost money. He had a toll-free number, he joked, that he could call whenever he felt tempted to invest in an airline. It would talk him out of it, and then, with the same pen and the same letter, he would explain with crystal clarity exactly why he bought, what he was looking for, what a good business actually looks like from the inside, the franchise value, the pricing power, the management that runs the business as though they own all of it and intend to for the next 100 years, the moat, that wonderful word, the competitive advantage so deep and wide that no competitor can easily cross it. These letters, read in sequence across 6 decades, constitute something that no MBA program has ever quite replicated, a complete map of one mind's evolving understanding of how capitalism actually works. And the most remarkable thing about them is that they are written in plain English, no jargon, no equations, no impenetrable financial terminology. Warren Buffett writes as though he is explaining his investments to a smart, interested, non-expert friend. Because that's what he is always doing. He once said he wrote the letters imagining his sister Doris, a smart woman with no particular financial training, as the reader. If she couldn't understand it, he hadn't explained it well enough. Think about that. The most sophisticated investor in human history, writing his annual financial accounting as though his sister might read it. That is not condescension. That is intellectual honesty, the kind that most of Wall Street is structurally incapable of. In 1999, the NASDAQ was on fire. Every week, a new internet company was going public and doubling in price before the ink dried on the prospectus. Pets.com, Webvan, Cosmo.com, companies with no revenue, no profits, no plausible path to either, being valued at billions of dollars by a market that had completely abandoned the question of whether a business actually made money. And Warren Buffett was not buying any of it. The financial press turned on him. Fortune published a cover story asking whether Buffett had lost his touch. Barron's called him out of it. The smart money, the hedge funds, and the day traders and the momentum chasers were getting rich. And the old man in Omaha was sitting on a pile of cash and Coca-Cola shares, reading annual reports. The critics had a point on the face of it. If you had owned a NASDAQ index fund from 1995 to March 2000, you had turned every dollar into 6. Buffett, over the same period, had underperformed. And then the dot-com bubble popped. The NASDAQ fell 78% from its peak. Trillions in paper wealth evaporated. Companies that had been valued at billions became worth the electricity bill for their servers. Berkshire Hathaway barely moved. Buffett was asked about his refusal to participate in the bubble. His answer introduced one of the most important concepts in his entire philosophy, the circle of competence. He said, "I don't invest in what I don't understand." Technology companies in 1999 required an assessment of competitive advantage in a landscape that was changing faster than I could evaluate. I couldn't know which of these companies would be dominant in 10 years. I couldn't determine their intrinsic value with any confidence, so I didn't invest. That is not a limitation I apologize for. It is a discipline. The circle of competence is not about knowing everything. It is about knowing exactly what you know and, more importantly, what you don't. The dangerous investor is not the one who knows nothing. That person simply doesn't invest. The dangerous investor is the one who doesn't know the boundary between what they understand and what they only think they understand. Buffett had a clear, honest map of his circle. Consumer brands, inside. Simple financial products, inside. Capital-light businesses with durable competitive advantages, inside. Fast-moving technology companies with uncertain competitive landscapes, outside. Not because technology was bad, because he couldn't assess it with the confidence his system required. He stayed in his lane. While the rest of the road was burning, he drove steadily forward. But here is where this documentary has to be honest in a way that hagiographies of Buffett often aren't. The circle of competence kept him out of the dot-com wreckage. It also kept him out of the dot-com fortunes. He famously did not invest in Google, despite his long relationship with and investment in newspapers and media. He did not invest in Amazon, and has openly acknowledged that he understood what Jeff Bezos was doing, admired it, and still didn't buy. "I was too dumb to realize it," he said. Apple he eventually bought in 2016, making it Berkshire's largest equity holding. He made approximately $120 billion on the investment, but he waited until Apple looked less like a technology company and more like a consumer products company with extraordinary brand loyalty and pricing power. That is, until it looked like something inside his circle. He missed 2 decades of the greatest wealth creation in human history because he wouldn't step outside his lane. Was that right? Was it wrong? It depends entirely on your philosophy of risk. Buffett's position is consistent and unambiguous. It is better to forego certain gains than to risk what you cannot afford to lose on what you do not understand. He has never deviated from this in 70 years of public investing. And the cumulative record, $150 billion, starting from $5,000, suggests the philosophy is not wrong. But it is not perfect. Nothing in finance is perfect. The greatest investor in history spent 30 years watching technology compound at extraordinary rates while he bought railroads and confectionery companies. That is the cost of discipline. It is real, and he has never pretended it isn't. There is a version of the Warren Buffett story that leaves out the personal entirely. The annual letters, the Berkshire meetings, the quotes about moats and circles. It is a comfortable version. A version that turns a complicated human being into a financial mascot. We are not going to tell that version. Buffett married Susie Thompson in 1952. She was vivacious, politically engaged, emotionally warm, everything her husband was not in social terms. She organized their family life. She raised their 3 children. She made their house in Omaha into a home. And she made Warren Buffett's career possible because the man who could sit in a room and read financial documents for 16 hours needed someone to manage everything else in the world. Susie did that, quietly, without complaint, for decades, and she paid a price for it. In 1977, Susie Buffett moved to San Francisco, not to divorce, they never divorced, but to pursue her own life, her own music, her own selfhood. She had spent 25 years in the orbit of a man who was, by his own accounting, better at managing capital than at emotional intimacy. In an extraordinary arrangement, she introduced Warren to Astrid Minks, a woman who became his partner in Omaha for the next 3 decades. The 3 of them remained close. They signed Christmas cards together. It was, by any conventional measure, deeply unconventional. And by the accounts of everyone involved, it worked in the particular way that unconventional things sometimes work when everyone is honest about what they need. Susie died of cancer in 2004. Warren Buffett, who had maintained the composure of a Swiss bank through market crashes and congressional hearings and corporate crises of every variety, wept publicly. His daughter described him as devastated in a way that suggested he had finally understood, too late, the full weight of what he had been given and how often he had not been present enough to receive it. He married Astrid in 2006. He was 75. He has spoken about this chapter of his life with more honesty than most public figures manage about anything. He was not a good husband in the conventional sense. He was not present in the way his family needed. The focus that made him the greatest investor in history is the same focus that made him an absent father and an emotionally distant partner. The gift and the cost are the same thing. They always are. In June 2006, Warren Buffett walked into a press conference and announced that he was going to give away 99% of his fortune, not when he died, now, over time, in tranches, beginning immediately. He was giving $31 billion, the largest single charitable donation in American history at that point, to the Bill and Melinda Gates Foundation, not to a Buffett Foundation, not to an institution bearing his name, to someone else's foundation. His reasoning was, again, characteristically Buffett. The Gates Foundation had better infrastructure for deploying this capital effectively than anything he could build. The goal was impact, not legacy. He was allocating to the highest return option. Even in philanthropy, he was optimizing. He has since given away more than $50 billion and has stated that his estate will give away virtually all of the rest after his death. The children receive enough to live comfortably, not enough to do nothing. He has explained this with a metaphor that will stick in your mind. Imagine, he said, that on the day you were born, a genie appeared and offered you a choice of the circumstances of your birth. Your country, your family, your economic situation. You would, naturally, try to choose the best possible circumstances. Now, you didn't choose to be born in America in 1930 with a brain wired for capital allocation during the most extraordinary expansion of capital markets in human history. That was luck. The scale of his wealth reflects, in large part, not his virtue, but his fortune, in both senses of the word. Hoarding that luck in perpetuity, passing it down dynastically, felt to him like taking credit for being dealt a good hand. The logical thing, the honest thing, was to recirculate it where it could do the most good. Whether you find this moving or performative depends again on your priors. What is undeniable is this: he is doing it. The money is leaving. Bill Gates has said the foundation has been transformed by the capital and the intellectual framework Buffett brought to it. He turned philanthropy into an allocation problem, and he solved it the same way he solved every other allocation problem in his career, with patience, clarity, and the willingness to admit when someone else was better positioned to execute. Let us do some arithmetic, because the arithmetic is the point. If you had invested $10,000 in Berkshire Hathaway in 1965, the year Buffett took control, and held it without selling for 60 years, your investment would today be worth approximately $400 million. Not 4,000. Not 400,000. 400 million. From $10,000. The S&P 500, over the same period, would have turned your $10,000 into approximately $3.2 million, which is also extraordinary, but it is 396.8 million less extraordinary than Berkshire. The compounding rate that produces this outcome is approximately 19.8% per year, over 60 years, without a single negative year in the first 13, and with a long-term record that no institution, no hedge fund, no index, no algorithm has come close to matching over a comparable period. This number, 19.8%, deserves a moment of silence. Because 19.8% doesn't sound like much when you say it out loud. The difference between 19.8% and the market's 10% sounds like 9 percentage points. 9 percentage points per year sounds like a modest edge. 9 percentage points per year, compounded over 60 years, is the difference between $3.2 million and $400 million. That is why Einstein, or someone who may or may not have been Einstein, called compound interest the eighth wonder of the world. It is not linear. It is exponential. And exponential curves, over long enough time horizons, produce outcomes that the human brain, evolved for linear thinking, cannot intuitively process. Warren Buffett understood this at age 7. He never stopped understanding it, and he never once, not in 1969 when the market was frothy, not in 1987 when it crashed, not in 2000 when the internet was eating everything, not in 2008 when the system itself seemed to be failing, did he stop letting the compounding work. The secret is not intelligence. The secret is not access. The secret is not information. The secret is not stopping. Every year, 40,000 people travel to Omaha, Nebraska. They come from Tokyo and London and Sao Paulo and Sydney. They take notes. Some of them have been coming for 20, 30, 40 years. The town fills up. The hotels are booked. The steakhouses have waiting lists. They come to watch a 90-something man and his 100-something partner sit in folding chairs and answer questions for 6 hours. No teleprompter, no prepared remarks, just questions from shareholders, sometimes sophisticated, sometimes naive, sometimes confrontational, answered with a directness and a generosity that is almost shocking in the context of modern corporate communication. They called it the Woodstock of capitalism. The comparison is more apt than it seems. Both events draw pilgrims. Both are built around a belief system. Both produce, for the people who attend, something that feels like it might be important, something worth traveling for. The difference is that Woodstock was about the feeling. Omaha, at its best, is about the understanding. Buffett has been asked at these meetings about everything: derivatives, financial weapons of mass destruction, the national debt, artificial intelligence, his mistakes, his regrets, what he would do differently, what he would do the same. He has been challenged by activists on climate, on gun stocks in the portfolio, on political donations, on executive compensation. He engages with all of it, not always satisfyingly, not always with the answer his questioners want, but with the consistent posture of a man who has nothing to hide, who has, in fact, spent 60 years in public, explaining his every move in writing, and who has therefore built the kind of credibility that comes only from never having been caught in a serious inconsistency. That is the rarest thing in finance, not the returns. Extraordinary as they are, the credibility, the 6-decade record of saying what he means and meaning what he says. Let's do the accounting, not the financial accounting, the intellectual accounting. What specifically did Warren Buffett teach the world? 1. Temperament matters more than IQ. He has said this so many times it has become a cliché, which is a shame because it is profoundly, provably true. The market does not pay you for being smarter. It pays you for being more rational, specifically for being more rational when everyone around you is being irrational. The great investors are not the people who find the best ideas. They are the people who, having found good ideas, can hold them while the market tells them, loudly, convincingly, repeatedly, that they are wrong. 2. Time is the most undervalued asset in finance. The entire Berkshire model is an argument that the financial industry's obsession with quarterly earnings and short-term price movements is not just unhelpful, but actively destructive. Buffett's holding period, famously, is forever. Not forever as a tactic, forever as a philosophy. Great businesses, given time, reveal their value. The job of the investor is not to predict what happens next quarter. It is to identify greatness and then get out of its way. 3. The moat is everything. Every business Buffett has owned for decades has a moat, a sustainable competitive advantage that prevents competitors from eroding its economics. See's Candies, brand loyalty and emotional association. Coca-Cola, global distribution and 130 years of brand equity. Geico, low-cost production through direct distribution. BNSF, railway, literal infrastructure that cannot be duplicated. The question he asks of every potential investment is, what prevents a well-capitalized competitor from taking this business away? If the answer is nothing, he walks away. 4. Price and value are not the same thing. This is Benjamin Graham's lesson, perfectly absorbed and transmitted. The stock market tells you what people are willing to pay for a business today. It does not tell you what the business is worth. These two numbers converge, eventually, but they diverge dramatically in the short run. The investor's edge comes entirely from exploiting the gap between them, buying when the price is below the value, and having the patience to wait for the market to close the gap. 5. Understand what you own. The circle of competence is not just an investment strategy, it is a life strategy. Know what you know what you don't. Act accordingly. The most expensive mistakes in investing, in business, in life come not from ignorance, but from the failure to recognize the boundary of your own understanding. 6. Character in management is not optional. Buffett has walked away from good businesses because he didn't trust the people running them. He has held businesses with average economics because the managers were exceptional. He has written about this extensively. You can assess a business's financial position with numbers. You cannot quantify integrity. But integrity is the variable that determines whether the numbers you're looking at are real. 7. Give it back. This is the lesson that doesn't make it into most finance curricula. Wealth is not neutral. The scale of capital that accumulates to one person in a single lifetime is, in Buffett's own framing, partly luck. The luck of birth Of timing? Of a society that rewards a specific cognitive configuration. The honest response to that luck is not to hoard it. It is to use it. We have now spent several hours in this series with the giants. Rockefeller, who built physical infrastructure so essential, it powered the modern world, and destroyed competitors to do it. Branson, who built brand experiences and the philosophy of the underdog. Volkswagen, which built engineering excellence and then corrupted it catastrophically. Trump, who built mythology and demonstrated that the story can become an asset class in its own right. Where does Warren Buffett sit? He sits, I would argue, in a different category entirely. Not because his returns are better, though they are. Not because his character is purer. Human beings are complex, and Buffett's personal life has its own shadows, but because of what his method represents in the history of capital. Rockefeller used monopoly. Explicit, ruthless, regulatory arbitrage monopoly. He built an empire by eliminating competition. Trump used narrative. The story as the asset. The brand as the product. Buffett used patience and understanding. He built wealth by correctly identifying the genuine value of real businesses and holding them long enough for that value to be recognized and then compounded. There is no exploitation in this model in the structural sense. He didn't eliminate his competitors. He didn't manipulate markets. He didn't use special access or political power. He read annual reports and thought more clearly than other people about what he read, and he produced, from $5,000 and a bedroom in Omaha, a financial outcome that makes Rockefeller's inflation-adjusted fortune look like a rounding error. The boring man won. The patient man won. The man who drove himself to McDonald's and lived in the same house for 67 years, and ate cherry Coke and See's peanut brittle, and read annual reports for 16 hours a day. He won by a margin so large, it strains the capacity of numbers to express it. There is something in that which should make every person who has ever watched a trader on television, or followed a hot stock tip, or wondered whether they were missing the next big thing, pause. The next big thing is never the next big thing. The next big thing is always the same thing. It is finding genuine value, buying it when others can't see it, and then refusing to be moved by the noise. 70 years, 19%, 400 million from 10,000. Boring, methodical, unstoppable. The snowball, Warren Buffett's own metaphor for his career, starts small. It starts with gum sales and paper routes and a red notebook and a library book about 1,000 ways to make $1,000. And then it rolls. Slowly at first, down a long hill, and it picks up snow with every revolution, and the snow it picks up in the first year is almost nothing, and the snow it picks up in the 10th year is more noticeable, and the snow it picks up in the 40th year is astonishing, and the snow it picks up in the 60th year, in years when the ball is already enormous, is the kind of number that stops conversations. The secret was never the snow. There was always plenty of snow. The secret was the hill. Finding the right hill, a long one with good snow, and having the patience to stay on it when everyone around you was telling you to try a different hill. He has been trying to tell us this in plain English for 60 years, in letters, in interviews, in 6-hour question and answer sessions in a convention center in Nebraska. Most people hear it and nod. They then go look for the hot stock. A handful hear it and understand it. And they sit down, quietly, and start reading annual reports. The gap between those two responses is the gap between ordinary and extraordinary, between the noise of the market and the signal underneath it, between the story of wealth and the reality of it. Warren Buffett is 94 years old. He still goes to the office most days. He still reads for 6 hours before lunch. He still has a cherry Coke on his desk and a copy of a Moody's manual on the shelf. He still occasionally drives himself to McDonald's. And the snowball keeps rolling. If this series has taught us anything, it is that the history of finance is the history of human nature. Rockefeller's efficiency, Volkswagen's hubris, Branson's restlessness, Trump's mythology, and Buffett's patience. Subscribe for more stories about the people who rewired the modern world. Leave us a comment. Who should we cover next? We'll see you in the next one.